guys think it's going to be systemic?
Well, it seems to be dragging everything with it, crypto-wise, I mean. It's obviously not a nice thing when these things happen, but it just shows vulnerability.
Okay, I just have something to share. I got short S&Ps yesterday. I think this is a failing rally off this last break. And I actually think that we might even be able to revisit around the 3,600 level going into the end of the month. So I think it'll be, if that scenario unfolds, I think it's going to be a good test for the dollar and also for the gold. I wanted to ask you, Stel, we didn't close the silver over 21.5. You still going to wait for that?
I actually, this morning, I got a bit hasty. I took a very small, but I took a small long at 21.50. So that's a little bit underwater. So I'm, as I said on the flow show this morning, I'm looking to slowly accumulate. I still have a very small position, but I want to keep adding and adding.
Okay.
Ideally, I want to see a daily or even better weekly close above 21.50. We haven't got it yet, but the correction seems relatively feeble so far.
So far, yeah. Tomorrow will be the day.
It will be, yes.
Yeah. Okay. And the yen's recovering. I was kind of thinking dollar rallies, maybe back to 110 and we get one more break towards 108. And then I'm actually looking for the potential of a new high in the dollar. I think that too will be a good test for precious metals. Something I don't think anyone's talking about, that this could just be another failing rally in gold unless we start clearing 1720. At least if you're long where you're wrong again, back under 1680. So that's really the key. I thought it was a pretty good move to the downside yesterday in yields. Again, tomorrow could change the picture and change this into potential. Either it's going to be a failing rally or we blast up to 440, 450 for a third drive. I don't think it'll confirm if it does that. And something I did notice on TLT, that intraday, it doesn't look like it really ever did fill the island bottom here. So you still have a higher low in bonds. And I think it'd be really have people wrong-footed if we get a bond rally and yields drop and the market drops at the same time and the dollar rallies at the same time. I don't think anyone will expect that. And that could be because of growth scares. So just something to keep in the back of your mind. But I think the 3860 was important, kind of a...
Is that Steve ordering lunch?
I muted him. Yeah.
Oh, good. Thank goodness somebody had the balls to do that.
Yeah. How you doing, Blake?
Good morning.
Yeah.
I'm tired. I was up a little late last night. How you doing, Dale? You sound tired, bro. Too.
It's a daily occurrence.
It is a daily occurrence, and but did you watch the elections last night?
A little bit. What's your take? Kind of we still don't really know, but not the kind of sweep that the Republicans were hoping for. Is that where we're at?
And I was telling the chat room, I think that's one of the reasons why the market's stalled overnight. Not seeing that red wave, especially across the Western United States. And I don't know if all the votes are in or because I have, like you get up early and you haven't had a chance to absorb it all. But to me, it does seem like that the markets kind of are stalling here because we are, we don't have the not getting that red sweep that we were expecting. And especially on the West Coast, I was thinking, we were going to see a couple of these states turn red, believe it, and they haven't. So anyway, but
so market wise, Blake, any strong conviction in front of the number tomorrow?
No, I mean, we have CPI tomorrow, and I think that's going to be important. And today it seems like the market is well, one of the things that I'm a little worried about, and this is to be perfectly frank with the dollar, because the dollar was looking a little bearish yesterday, and we held a lot of key levels. We made in some currencies, we made actually false breaks, and that's even with, well, I guess, with the FX market kind of pivoting here, that's a little nerve-wracking, because you got crypto looks like it's absolutely going to get destroyed here. And if crypto really comes under pressure with this FTX news, and I mean, this is I'm sure Stelios has some words about this, but this is the third largest crypto broker, which is, looking to go.
He was bailing out everyone else. He was coming to the rescue for all those. I think, didn't he buy Celsius or what was left of it? And someone posted a picture of, I forgot what magazine he was on. Banks, is that his name? Bankman or something?
Bank something. Yeah.
Yeah, and underneath it said the new Warren Buffett, and then someone put up that didn't age very well. That was only like 6 months ago. He was the new Warren Buffett.
Yeah, and so when it didn't age very well, did it? But this is what worries me. Like I've got money just sitting at Coinbase, and I'm like, this is me thinking out loud. I'm just telling you guys, when this happens, I think, shit, I need to pull my money out and I'll put it in. I'll keep my Coinbase account open, because there's some point I do actually want to be long Bitcoin or Ethereum or whatever I decide to choose at that point. I do want to be long, but do I need to keep money in an account to do it? I'd rather just be for sure that the bottom is in. Then I'll deposit money into an account, and then I'll get long. You know what I mean? Like me keeping cash in a crypto account right now is a little nerve-wracking, and I'm sure I'm not the only one feeling that way. You know what I mean? So
you don't even have to keep it in an account. I don't know how to do it, but you just put them in cold storage.
Yeah. Wallet, I mean, you can put them in a wallet or whatever. But but why the hell would I want to own Bitcoin right now in a cold storage in a wallet if it's 18,000 or below 18,000 right now, and I think it's actually going to 3,000 before I can buy some?
Oh,
I mean,
okay, yeah,
you guys go ahead and buy some. I mean, feel free.
I'm gonna be buying, Blake, both hands.
I mean, no,
no kidding,
but
really,
but I'm just,
of
but
course,
I'm just saying,
not
guys,
Dale.
Like, look, if you guys,
I'm not,
you guys can do whatever you want. I'm not telling you anything other than I don't feel secure with my money in a Coinbase account, because I was trading, guys. It's not like I'm sitting here going, I'm going to buy Bitcoin, I'm going to hang on to it for 40 years because it's going to be the next best, greatest thing to gold or whatever. I'm not in that camp. I'm in the I'm going to trade Bitcoin and make money camp and Ethereum. And I've been doing pretty well trading it over the last, year, but I sure as hell don't feel comfortable about buying crypto and hanging on to it, because I do think it's going to be, fractionally, it's going to be much lower than it is right now before it hits bottom. Me personally, that's how I feel. So therefore, I'm not going to just go ahead and buy stuff and throw it into cold storage when I think I can buy stuff for fraction of the cost, a year or a year and a half from now. So, that's just my opinion. But
by the way, where are the NFT people? Where's the NFT crowd? The guys that were paying hundreds of thousands of dollars to get a pixel monkey.
You mean 17.8 million?
Yeah, but Steve, look, I've made bad decisions in the markets. We all have.
Yeah. I don't think
no need
you've
to
ever
call
made
those people out. I mean,
I don't think you've ever made such a bad decision, or I don't
are you
think
kidding
you would
me?
ever make
I've got hundreds of thousands of dollars I invested in .com companies.
Wait a second. At what age are you talking about now? Now you're talking about.
I was in my 20s, but still.
Yeah, there you go.
That's my
point.
no, the point is people get caught up in the hype. So it's, you know, it's part of trading. So just, you know, like, look, there are people that got caught wrong sided. They got caught in the hype. So be it. I mean, it happens. No need to beat them up.
I'm living in a virtual house. I couldn't buy real estate, so I bought a virtual house.
Textbook expected blow up in what we call malinvestments. All these euphoric markets that had zero intrinsic value were the epitome of malinvestments that were created after 15 years of reckless monetary policy. And obviously, as it always happens, they're now unwinding.
Right. But you know, if you're stuck in them, no need to beat a dead horse. They're you know, look, if I don't own any NFTs, but if I did, I would feel pretty bad about it. So I don't need to feel more bad. You know what I'm saying?
Well, you could live in your virtual house. I mean, there was a bull market.
I mean,
virtual real estate.
I think the writing on the wall is just seeing what metaverse is really turning into, and you go, wow, you know, I mean, there's a lot of work to be done in the world of digital anything. But I want to go just look at technically what we've got with Bitcoin, because this is a problem. Technically, we spent the entire summer consolidating. It's summer and fall, and now here we are going into winter, and it looks like we're going to break down further. So, you know, if you guys want to buy Bitcoin and put it in a cold storage or crypto or whatever it is, I get it. But based on what we're seeing right now, I mean, we get a clean breakdown, which it looks like we're going to, you know, the next stop is probably around 10,000, maybe even lower than that. I mean, I would think that somewhere down here, maybe the long-term trend line comes into play somewhere around here, which I would be interested. I would be interested in buying Bitcoin somewhere down here around the 7,000, 8,000 level. But to me, when you have an asset that doesn't go up, you know, after a steep fall like this, it's probably got further to go. You know, there's something that you guys and gals hear me say quite a bit. What does not go up usually only has one other direction to go. And that in this case, you're not seeing any bounce in crypto. We probably got further to go. And there's further pain. Look, there's so many people that are riding on Bitcoin, crypto, and they have their whole life and careers around it. We're probably going to end up seeing a washout. Unfortunately, you're going to see people get, you know, even more destroyed. I mean, it happened in the .com bubble. You guys listen here for years know that that's the thing that we've been preaching. It looks very much like .com. We've been saying that for Dale. How many years? Maybe 3, 4.
Yeah.
Right.
I think almost the whole time we've been in business.
Yeah. I mean, it is
even during the bull runs. So,
yeah.
You know.
Yeah, even during here, you know, we had the same attitude, and I think we have more of the attitude here. I mean, it is just basically a repeat of the late 90s. And
how's the VIX look to you, Blake, when you have a chance?
Let's take a look at the VIX, and let's take a look at, you know, at other markets. Volatility is nice and benign. But I think one of the issues that we have with Bitcoin's still on my mind here, with volatility, is that we're back at a 618 retracement.
I like it here.
What's that?
I kind of like it here.
Yeah, and this is one of the risks of the dollar. So, you know, let's talk about this, because if volatility actually bounces here, that's usually a, you know, bearish sign for equities. And I know it's hard to get too bearish ahead of tomorrow's inflation data, but, you know, it is the inflation data. And if CPI comes in stronger than expected, you know, what's going to happen? We're going to see stocks a lot lower tomorrow. We're going to see us snap back down at 3,700. So, you know, from the VIX point of view, buying down here on this dip does make sense. It seems like, to me, it's a value play, right?
Yeah.
So,
in fact, Pavel Hala, who we had on, and he has a very good track record with his forecasts on F.A.C.E. He called the VIX one of the most undervalued asset classes out there right now.
Well, this is a guess from a couple of days ago, Monday or something?
Yeah.
Okay, cool.
Yeah.
Well,
it's good.
Well, maybe I don't know if it's an asset class, but
or just undervalued. Well, he used the word extremely undervalued.
Okay, well, you know, maybe, yeah. I mean, the VIX. I think if you're expecting a meltdown in the markets, that would probably be the case. But even so, I think it's a tradable, you know, range tradable asset where you can be buying these dips and looking for a move back up to, you know, the mid 30s, because you don't have to have a meltdown in the markets to get VIX back up at 34, 30, 36. You know, for VIX to get above 40, you need a severe breakdown in equities and high volatility. But I do think it's definitely tradable. I think you can trade like a range like this in volatility pretty easily. You know, for those of you that, you know, want to trade it, probably something like that, you know, buying down here, selling up here, right? You're not expecting you're not expecting us to see like 2,800 in the S&P over the next week, but you know, that means you're probably thinking that S&Ps are heading back down below 3,600 before we, you know, bounce again, and that would give us, you know, higher volatility. So I think that's a way to trade it. But I wanted to show you guys the dollar, and this is what I'm really worried about with the dollar. So the dollar is holding, you know, we didn't break. I was putting that there because I drew yesterday. If we get below 109.30, then it's bearish. That's our support zone. You can see it right here, right? And then you can see that previous high right here. This is a support zone that we've been looking at. I should do it like that. There it is. Okay. In the ForexAnalytix community, you can actually see it. You can see it right here, right? So there's your chart from yesterday. Same chart. We were holding support, and we held it. And you can the risk right now is if the dollar gets a bounce from here, and which we are getting. But if you look at some of these other currencies, like you take a look at the euro dollar, we got. Here, let me zoom in a little bit. You got this false breakout of this. Sorry, there we go. You got a false breakout of this triangle, a rejection of the highs. So you got, like, you know, obviously really key resistance, or maybe, you know, I know a lot of you are like double top, and it's just not even close to a double top. We'd have to break all the way down here before it's a double top. But it is resistance, right? You got resistance up here. You got the sterling that had a false break of this triangle. You have the Aussie, which inverted head and shoulder pattern, false breakout thus far. There's still a lot of time left in today. But what you can see here, the point I'm trying to make is the dollar is not breaking down. And that is a little bit of a risk, I believe, to risk appetite. So for those of you that are, you know, bullish stocks, you've got to be looking at the dollar going, okay, now I need to start paying extra careful attention. Then you see gold too. Gold, I mean, we had a great move yesterday, but you know, we're not building on that. We could be building a bull flag pattern, right? But I think a lot of whatever you're seeing right now, you're going to see either reversal or follow through, you know, following tomorrow's data. Tomorrow's data is that important to the market. So anyway, those are just some initial thoughts. What are you thinking here, Ryan?
On what?
On everything.
Dollar, gold, Aussie.
Ponder life a little bit, because that's what we cover here. Life. What are you thinking about life?
To life, l'chaim, l'chaim, to life. That's from Fiddler on the Roof.
Yeah, you got me, Dale. That's before
Fiddler on the Roof. You got.
No, I know, but I saw that when I was a kid.
All right, well,
I know you saw it in your 80s, but it's cool. Just kidding. Just kidding.
I will see it in my 80s. Thank you, Blake.
All right, no, sorry, Ryan. What are you thinking? What are you thinking?
I'm seeing we've had a few breaks of levels, but then they've run straight into other brick walls. You know, you've got gold up there. We had the break over the 75-85 area. We slammed into the 100 DMA, which is right on the highs there. We've got an old fib. The 38.2 fib, I think, is an old one at 1725. There's another level at 1722. So, you know, we get over one level, but it runs into another. And if we can't take out that next area, then we're probably going to move back down towards that 1685 area. Aussie dollar's the same. You know, had the breakthrough 65, couldn't get through my 2040 zone. Again, moving average in play there to 55 DMA, I think it is, marking the top, and we're back below the zone again, back in the box. You know, so we have had some moves, but they're not confirming. Like you say, if you're watching the dollar, it's not collapsing, it's not getting away from itself.
Yeah, I mean, look at the dollar yen. I mean, this is really, you know, coming out of the wedge. We talked a lot about this yesterday with K-Man. I'm not sure where he's at today, but we were talking about this 145 level, really critical. Couldn't break it, and I mean, that's just another example, right, of the dollar just not following through yet.
Yeah, just not ready to go. Just not ready to go yet. And what are we now? 146.33. So a decent bounce off of that area at the moment. It confirms a range, and I think dollar yen is, if we've got a solid hold of that 145 area, low 145s, we're probably going to consolidate further. You know, maybe see a move up to 148 at a push, 148.50, 149, and you know, because there's nothing in the pipe that's going to push it out of that range for now. You know, even a strong CPI, you're not going to see 150s tomorrow, you know, unless it's something stupid in dollar yen. Conversely, if we get a weaker number, that will probably put the pressure on that 145 area. But if we're at 146 and a half, 147, that's probably going to be a decent stretch point for a bad number.
Yeah.
So
I know there's people hoping for people are hoping for a weaker number. You know, me as a human being on planet Earth, I hope we get a weaker, you know, inflation print tomorrow. But like Steve, you don't believe we're going to see weaker inflation tomorrow, do you?
Mate, it's not my job, and I've never made it my job to guess what happens from print to print, right? And you know that this shouldn't be our job. So my trading is not based on a single number that can be volatile, right? Now, based on what we know having to do with the Stel just talked about it a couple of days ago, the chances are not in favor of a lower number in this print, but who knows, right? One thing I know, the markets seem obviously eager to finally get something positive to cheer about. We've already seen the dollar being rather weak despite, you know, all that the Fed has been giving us, Powell has been saying, so on and so forth. So I can tell you one thing, I think that if we get a weaker number in inflation, which is a big if, we might see a big move lower in the dollar and higher in equities, but the chances are against such a possibility.
All right. Well, you know, thanks for your input there, and you know, and I believe that tomorrow is going to be really key. Stelios, what do you have any ideas going into the inflation data tomorrow?
Yeah, as I said before, I think it's probably going to be a little bit better than expected, higher than expected. But look at China's inflation. Came out today, down from 2.8%. It was expected 2.4. Year-on-year came in at 2.1. So that's, you know, obviously we take the numbers with a pinch of salt, but still we are starting to see some prints in some, you know, major current countries looking like they're abating. So this is going to happen in the US for sure. We know that. The question is when. I still think it's going to happen early 2023.
Do we know that?
It will.
And
do we know that? I'm trusting you that we do.
It's not about if it's going to happen, right? It's also the pace that is very important, because even if somebody tells you with certainty that, listen, for, you know, we've seen the high in inflation and for the next 2 years inflation is going to be trending lower, the next question you should be asking is at what pace? Because if it's trending lower and in 2 years from now we're still at 6%, that's not really helpful, is it?
Bingo. Yeah. Bingo.
Yeah,
absolutely, Steve.
I just find it very difficult. It's a very high hurdle rate to be, you know, comparing year on year with this year, which had already, you know, a huge jump in inflation. When we get to early 2023, we're going to be comparing to that.
To that,
So that, you know, if inflation goes down to zero, it's still very bad, right? Because we're still baked in all this increase that we've had over the past 12 months, which is bad. Theoretically, we need to see negative inflation to go back to, normality, if you want to call it. So
I've talked about that before, Stelio. You remember that they had pulled out of the drawer of economic stupidity or thinking, they would call it, the idea. You remember the concept of symmetrical inflation?
Symmetrical, yeah.
Which once we really got inflation high, nobody has mentioned the concept again ever. Right? So now they don't want inflation to be symmetrical, which would mean, in essence, that we need to compensate for the very high inflation by having a period of very low inflation, because now the concept of symmetrical is not convenient anymore.
Well,
what happened to AIT? Anyone remember that?
What? No, what'd you say?
AIT.
What is AIT?
See, you've all forgotten. Average inflation, whatever it was called.
Yeah.
The Fed's measure. What happened to that? It's all been forgotten about.
Well, you know who's going to be a perfect person to talk to about all this inflation measures is going to be Luke Groman, and I'm sure Dale's going to ask him a lot of questions regarding tomorrow. Hey guys, look, we have just a few minutes before. Do we have economic data coming out? Let me just. Do we?
No.
We don't come not in the next few minutes. Tomorrow, remember, we'll be covering CPI live as we always do here on the F.A.C.E show. But before I go, and before we go, we have just a few minutes. What's your best ideas for today? Like, for me, I'm just going to say this right now. I'm a little worried about the dollar. I'm a little worried about this false breakdown in the dollar. So if you guys are short dollars, and by the way, I do have some dollar shorts on right now. I'm not sure I want to stick with them for the remainder of the day. So and they're small because I put them on yesterday just in case we had a continuation in the stock market. But with the election results the way they are, we're not seeing that red wave. So I am a little worried about being short the dollar at this moment. But that's what I want to give a heads up going into tomorrow. What about you? Let's start with you, Steve. What do you think?
Listen, as you said, Blake, the DXY has held. The USD yen has held. It's what exactly you're showing at the moment. So theoretically speaking, we are well positioned for for both outcomes. In one outcome, we have a continuation of the prior trend. In the other outcome, we're going to see big breakouts in the opposite direction. Now, what has been, though, a game changer, in my opinion, is the big breakouts we saw yesterday in the metals. And I don't know if they, in essence, front run something else, but I can't easily ignore them, right?
Right.
So
all right, well,
I'm still focused on the metals, post, because I can't guess the number for tomorrow. So I'm still focused on the metals.
Okay, sounds good. You're still focused on the metals. And look, I love the fact that gold is holding up here. I mean, I think gold looks great, and any dip back below like 1690 looks, I think, stellar technically. How about you, Stel? What do you look? And don't tell me metals, because I'll scream.
No, I look at
I'm going to knock you out of this meeting.
I look at things that are on the verge. I look at things that are on the verge. So Bitcoin really at the lows now. It needs to hold here. If it breaks, I think it's going to go. I think it has a little bit further to go. So I think that's going to be a nice
scary, right?
Short. Yep. Even if it's down 6%, if it breaks, I think it's a good risk reward short. And that's what many people don't realize. Something can be down 6% and still be a nice short. I
mean, what's stopping Bitcoin from losing another 30% here over the course of the next few weeks?
Absolutely nothing.
Yeah, I don't.
And on the flip side, if things come out good in terms of inflation, so it's higher if inflation comes in lower and the dollar starts weakening, I'm going to be looking at dollar MXN, as I said yesterday, a short there.
But speaking of cryptocurrencies, Stelio, I think it's going to be a mistake from people that trade cryptos to think that the move we're now seeing has anything to do with data like inflation, etc. I think the potential breakdown we're seeing here is legit, and it won't have its fate changed by tomorrow's numbers.
Let me get Ryan's opinion really quick and Dale's. So Ryan, what do you think? And best idea going into tomorrow? Are you going to try to come in flat and open-minded? What are you thinking?
I'm going to hack your Coinbase account and buy all the Bitcoin I can.
Dude, I'm going to cash it out like literally today and move it back into my trading accounts, my normal trading accounts. But what are you thinking though?
Yeah, for me, it's just watching these levels now. You know, we've set some new highs, some new lows, depending on what you're watching. Just watch those. You know, if we're going to have a break, we need to take those out. If not, then unfortunately we're going to go back into the same old well-worn ranges. So I'm in management mode at the moment.
All right, Dale. I know you're going to be taking on Mr. Luke Groman, and I'm excited to hear what he has to say today. But do you have any good ideas going into tomorrow before we cover our inflation data live tomorrow? What's that?
At the beginning of the show, I said short S&P, so they already have 18 handles.
All right, nice. Look at Dale Dale's bringing the cheese.
Looking for 3,600, 3,600 by the end of the month.
Woo! There's a call. 3,600 by the end of the month, going in the direction of the trend. I like it. All right, guys and gals. Look, if you guys haven't checked out the Trader Funding Program, check out the Trader Funding Program. Watch this 2-minute video. See if you want to access our money versus risking your own money. Keep 75% of the returns. You have unlimited time to pass your assessment, and you get ForexAnalytix included with it for a period of time, so you can be in our trading community. Because we don't want to leave you out there alone. We want to make sure you have good trading ideas. Guys and gals, I'm going to pass it over to Dale and Mr. Groman. Dale, have a great one. Team, thanks for being here. As always, we'll see you live tomorrow we'll be covering the inflation data live as it breaks and what's moving at that moment. So we'll talk to you soon.
Thanks, Blake. Thank you, team, and welcome back to F.A.C.E, Luke. How are you?
Thanks for having me on, Dale. I'm doing great. How about yourself?
Pretty good, buddy. What's top of mind? Does midterms mean anything to you in your work?
Not really. I mean, it's interesting that the red wave was not as big as they thought, but not really. Not really.
Doesn't matter. The financial situation has been caused by both parties, right? So
it's both parties, and to me, I continue to think by far the biggest news that I've been surprised people have not paid attention to was what Treasury said last Monday afternoon. Everyone was so focused on the Fed meeting that they missed what I thought was the biggest news for the next 6 months for markets, FX markets, risk markets, et cetera, which is Treasury quietly came out and implicitly doubled their estimate for the U.S. deficit, federal deficit, over the next 6 months. And they put it in it was in the Treasury borrowing update. And it's so important because they came out and they said, all right, we're going to borrow $550 billion in the fourth quarter net. That's up 37% from 3 months earlier for their estimate for fourth quarter borrowing.
Who's buying this debt right now, Luke? I mean, I look at certain things like TLT, and I've been looking for a bear market rally for quite some time. It just can't deliver. I still think it's way overdone. But who's on the other side of this collapse? And really, does the U.S. Treasury market look any better than the gilt market does in the UK? Are we in the same type of situation, maybe just not as extreme as the gilt market?
We're in the same situation. It's not as extreme because we're the reserve currency and because you have the euro-dollar market that creates some dollar demand that in sizes that doesn't exist for the sterling. But we also are orders of magnitude bigger in terms of the debt problem that the UK has. So there's puts and takes to it. So what it tells you is that tax receipts in the United States are collapsing in real time, right? That the fact that they're increasing. Now they called it fiscal developments. I think fiscal developments. I think they referred to it as tax receipts are collapsing as a result of the Fed hikes. And so you've got now. Not only did they increase the borrowing to $550 billion from $400 billion in 3 months, they initiated a 1Q23 estimate of borrowing, which was 578 billion net, plus 200 billion in a rundown in the cash account, Treasury's cash account, the TGA. And so if you add the 200 back to the 578, you get 778. That's your proxy for what the deficit's going to be in the first quarter 23, according to Treasury. 778 plus 550 for 4Q. Next 6 months, we're going to be running a $1.33 trillion deficit over the next 6 months, which is roughly the size of the deficit of the past year. So you are running on an annualized basis a doubling of the deficit. And it's critical to markets because now we get a very binary decision. Is the Fed going to print the money to pay for it, or are they not? And if they don't, dollar's going up, risk is going down, everything else is going down. And within that context, the fact that gold is holding in the way it is increasingly interesting because Treasury, Fed are all now getting into a very dangerous game. Fed can tighten to fight inflation, but the second at some point, these markets are going to start getting concerned about fiscal sustainability in the United States. You had Larry Summers 2 weeks ago refer to a debt doom loop, and he's a former Treasury Secretary of the United States. I don't know what that number is.
Is that a synonym for sovereign debt crisis?
Absolutely. Absolutely.
Okay.
I think part of why the message to me of gold holding in so well with nominal rates rising the way they are, with real rates rising they are, is people are starting to do the math. The U.S. government can't afford the terminal rate. They can't afford the terminal rate that Eurodollar futures are predicting.
How much has interest expense increased in the last year with what has happened with rates, Luke?
Well,
has it doubled? Has
it? The short answer is no. 24 trillion in debt, 28% of it's going to reprice in the next 12 months. So 28 times, say 30 times 24 is 720, 720 billion. Say it's up, 300 bips year over year. So you're going to be, up whatever that works out to be, 100 billion, something like that. Or no, sorry, 150, 200 billion just on that part of the interest. But where the other things that are interesting, no one's doing the math. The cost of living increase in Social Security alone next year, it's going to be 120 billion. The Fed not remitting the money because the Fed is now upside down. It's 107 billion. So 107 plus 120, plus if we have a recession, which is increasingly looking likely, a 20%, a plain vanilla recession. Forget about a 2020 crisis. Forget about a 2008 crisis. Just a nice little plain vanilla 01, 91 type recession. You're going to get tax receipts down 20%. You get that tax receipts down 20% on 4.5 trillion in tax receipts. That's 900 billion. So I can double the deficit next year without really even breaking a sweat. 900 billion plus 120 plus 107 plus call it 240 in interest. That's no enrollment gains from more boomers retiring, et cetera, et cetera. So now you have this funding problem. To your question, who's been buying it? The stronger the dollar get, the Japanese are sellers, Chinese are going to be sellers. The whole world's got 7.5 trillion in treasuries for sale to defend their currencies. They got to sell treasury. The treasuries are piggy bank. So they got to break the piggy bank to get the dollars to defend their currencies or to buy energy. It's sort of one and the same. So you've got Fed selling, treasuries at 95 billion a month. Well, selling duration, right? Portion of that's treasuries. You've got Treasury selling treasuries, or they thought they were going to sell $1.3 trillion. Now they're going to sell 2.7, and that's assuming we don't get a nasty recession. That number in a nasty recession could easily be 3.5 trillion, maybe more. You've got foreigners, the dollars. If the Fed is not monetizing enough, if the Fed is not growing their balance sheet, dollar's going to go up in a disorderly way. And as that happens, you're going to see foreigners. And they've got 7.5 trillion for sale. I mean, the global private sector's been buying treasuries. They've bought, I think, 650 or 700 billion year to date. The two biggest buyers of that are the UK and the Cayman Islands. Hedge funds?
Yeah, I heard
and
that.
hedge funds.
Yeah, the Caymans.
Now,
yeah.
the thing about hedge funds is they want to make money, and they want to make money on a monthly basis. And the problem there is as treasuries break down, they don't just sit there and hold them. They'll turn sellers. And so now your biggest private buyers, they're purely profit motivated, and they've got a monthly mandate. So they turn seller. So this thing to me could get extraordinarily disorderly in terms of the dollar on the upside and everything else on the downside in a very short period of time. So it was interesting when you said, I see S&P down, whatever that would work out to, 10% by the end of the month or something. That makes sense to me. You can look and see the Treasury General account has fallen about 100, it's a little over 100 billion, 120 billion over the last 6 weeks. So basically, I think to paint the tape for the election, Treasury's basically been sterilizing Fed QT. And post-election,
Fed guy talks about some type of facility that the Fed may come up with to backstop bonds. To me, it's rocket science, what he talks about. Do you see them coming in with any type of measure to stabilize the bond market? Maybe
at some point, yeah. At these levels, no. I think you probably give back a lot of October's rally in equity markets first.
Okay.
And I think what the catalyst for that is a disorderly increase in yields, right? I think you have risk of the 10-year goes from 4.15 or wherever it is right now to 5.5 in 3 weeks, and you get something like that, and you go, oh God, then they're going to have to react, and CPI won't matter. The Fed's going to have to print money with CPI wherever it is at that day.
Well, this move in the dollar has been really, all it did was mark time. If it was going to be an important top, don't you think, Luke, we would have seen sharper breaks? And to me, it looks like you see this reading on RSI. I know it's technical, but markets rarely peak when momentum is confirming price. So even though I've been working the short side of the dollar, the process never gave me confidence. And I agree with you. I think there's something coming up going into year end that is going to drive the dollar to another high.
I agree. From a fundamental standpoint, this Treasury release would tell you exactly that's exactly it. Is someone's got to buy this debt, and the biggest marginal buyers are very price sensitive, which tell you rates are going higher, capital costs are going higher, dollar going higher, pretty much everything else going lower. I still like gold. I understand it probably marks time, but we're going to, at some point in the not too distant future, and we may already be at that point, I don't know, but gold is going to start going up with rates as people just do the math, which is U.S. government's, U.S. government is bankrupt without Fed help at, I don't know if it's 5 or 5.5 or 6 on Fed funds, but it ain't 10. It's well before 10.
And you mentioned I get your emails, Luke, the quality of the buyers and the quantity of gold that's being bought by these central banks. What were the numbers again? I mean, they're expanding dramatically the amount of gold they're taking down.
Yeah, it was really interesting. In the third quarter, World Gold Council came out and said third quarter central bank gold buying set an all-time record, which I think 400 tons in the quarter. Interestingly, 300 tons of it was undeclared, which is unusual. Who knows? But to me, the Chinese, the Russians, the Turks, or the people that have been the nations and the central banks that have been pretty open about this have been pretty open about it. I don't know why they would hide it. So to me, the fact that there was 300 tons bought in the third quarter in the middle of the biggest dollar move higher, when there's this dollar shortage, while they're selling treasuries with both hands, is interesting. And then you say, okay, who would be buying a lot of gold that doesn't, at the central bank level, that might not want it announced? To me, there's 3 most likely candidates. It's the Germans, the Japanese, or the Saudis, all of which would probably not want to, if I don't think they'd want to alert markets to that yet, because I think if any of us woke up and saw a headline that the Saudis had bought 100 tons of gold, or the Japanese had bought 100 tons of gold, or the Germans ditto, that has major market implications for the dollar, for geopolitics, etc. So my guess is I think it might be one of those three. But that's just spitballing. The bigger, more important picture is they're buying gold as they're selling treasuries in a dollar shortage and dollar tightness, as a time that real rates are rising rapidly. That's a play on this can't continue long. It's not sustainable, in my view.
Right, it's not an inflation play; it's a solvency play, isn't it?
It's a solvency of the global reserve currency issuer play. Yeah.
Okay, so I know a lot. You've talked about peak cheap energy, and peak cheap energy is definitely, even before the war, you were talking about this, Luke, and you know, we've vacillated in this range between 80, 90. What's this winter look like, and how does that exacerbate the global financial stress that we're currently seeing? Do you think that we're going to get another big run in energy over the winter? And
yes, I do. I do. Okay. You've run down the SPR, here too. I think the administration.
That was a great fade, wasn't it? A great break. Didn't Joe provide a great break to buy? That was a low for a very nice rally, but I appreciate when politicians give you breaks to buy. So what are we going to do if we need energy and there's a problem?
Energy going up is going to make this machinery all spin faster, because the bottom line is that it is going to push higher energy costs, push Japan, Europe, these major current in normal times, they're current account surplus nations, right? So they are recycling dollars into US financial markets. They are increasing their dollar asset piggy bank. When energy prices get too high, they need to buy energy because people don't like to be cold and they don't like to starve. And so energy is more important than the dollar. It's more important than treasury bonds. It's more important than other dollar assets. If oil, peak cheap energy, as we get into this winter, if I'm right, and oil prices, energy prices keep rising overall, it's going to accelerate the pace of foreign selling of treasury bonds. And a reminder, foreigners in total own $7.7 trillion in treasury bonds, 3.1 or 3.3 trillion at the central bank level. If it comes to a choice of freezing, starving, or selling treasuries and sending rates higher for the world, they will do the latter over and over till their hands bleed. And that's what we were seeing happen in August and September. September in particular started to get more aggressive. We've been seeing it all year. I think it's going to keep happening. And that's a really bad, basically, higher energy is really bad for risk. It's really bad for bonds. It's really good for the dollar. And again, eventually, I think it's probably keeps gold bid at the very least relative to what gold should be doing with real rates rising that fast. But ultimately, I think it's going to be good for gold nominally. I think gold goes up with oil as this situation continues to evolve.
I think one of the asset classes that has some of the most bullish fundamentals, no one talks about it. You talk about people not wanting to freeze or starve, and when I look at grain markets, they look like they've just corrected from the invasion. And if you look at how production is down 10 tons because of the warm summer in Europe and India. It's going to be down 30 tons in the Russia, Ukraine grain belts next year because of the war and not being able to plant. To me, it looks like this could really be something that people could use as a hedge as well, besides energy. In fact, I think the fundamentals are stronger in the grain market than they are. I don't like to have a bull market in grains, but I think agricultural commodities are something that, even if the Fed wants to continue to tighten, does not have as much influence over. What do you think about that?
I think that's right. I mean, for me, we've been telling clients I like energy, and I broadly define energy. It's not just fossil fuels. It's also uranium. It's also ag grains. Ag grains are simply, when you really look at what soybean, corn, wheat are, all they are is seed, sunlight, water, fossil fuels, you know, to vastly oversimplify.
Right.
And if you start taking away or making more expensive the fossil fuels, if you start restricting water, you're going to make these grains more expensive. And like you, as a human being, I'm well aware of the implications of that across the emerging markets.
Yeah.
That just, again, in the same way oil does, that reverberates back, unfortunately, into treasury markets, risk markets, et cetera, which is people need to eat. And
yeah, I mean, last time we had a situation like this, I believe it was 2010, 2011, we had the Arab Spring.
Yeah.
So, you know, it can create a lot of geo unrest when your population gets hungry. And China's been buying wheat for years and stockpiling it. They saw it coming. Anything else you want to cover, Luke? I mean, I really think that people should follow you and consider FFTT. And, you know, this is really, you know, your work is great. The testimonials are great. Going into year end, what is the most important advice you could give people between now and 2023? There's only a couple months left.
I think it is to continue to stay unlevered, and keep a very elevated cash position.
With some physical metals.
With some physical metals. To me, I personally, I'm very, you know, I don't trade, so I you know, I make more strategic adjustments, and it's, you know, we've been saying since April really that, you know, people managing a monthly book, you know, I would be in almost all cash. I'm not a big shorting guy, given the central bank regime we've been in. That's been wrong this year. That's obviously been wrong in terms of shorting equity markets and emerging markets, what have you. But for traders, I think it's critical to understand where we are in the big picture, which is we are coming to we're living through the first bursting global sovereign debt bubble in 100 years. And as that happens, it becomes extraordinarily volatile. It becomes extraordinarily political. And so I think it's important to understand it's going to be, that's why I say unlevered, nimble, don't get too far out over your skis. I mean, I have a chart that I put up from my friend Dan Oliver at Mermercan Capital. It shows the price of gold in German Reichsmarks as Weimar Germany was hyperinflating. Gold was going to $1 trillion. With that said, from 1918 to 1922, as gold went to $1 trillion Reichsmarks, went to, you know, the Reichsmark collapse. There were 4 or 5 different instances where people said, oh, the Reichsmark's going to run QT. They're going to implement austerity. They're going to strengthen the Reichsmark. People were selling gold multiple times to buy Reichsmarks from 1918 to 1922. So that if you were levered long gold, which if you look at that chart without looking at the ups and downs, you go, oh, this is easy. I borrow a bunch of money, I buy a bunch of gold goes to $1 trillion, I trade it all out. The reality of it was that if you were levered long gold in Weimar Germany from 1919 to 1922, you lost all of your money 4 different times because you got carried out on your shield because it's Bitcoin. Right? Hey, I'm going to buy, the US has a fiscal problem. I'm going to be levered long Bitcoin. Great. 70,000, 17,000. Now all your capital's gone. You're done. You know, that's what I mean. Why I think unlevered is so important. This is a once in 100 year, very volatile political situation that I think it's important traders understand that as they operate in these markets.
Okay, so 100 years ago, we know about the hyperinflation in Germany. Where was the sovereign debt crisis? Did the U.S. have one back then? Was it global? And how did it play out? And how did we come out of it?
It was global. If you look, you had the 6 biggest industrial powers: U.S., U.K., Germany, France, Japan, Russia. The sovereign debt crisis was ultimately the cost of World War I. We sat down, the Germans, we had made the Germans pay, and then the Germans had to pay the French and the UK. We demanded that the UK and the French repay us for the money we loaned them. How it worked out was Germany hyperinflated, Russia hyperinflated within a couple years after the war. The other four all saw their sovereign debt collapse against gold over the ensuing 10 to 12 years by 75 to 100%. So basically, inflation and currency devaluations, many multiple times, some just really big all at once. UK devalued the pound, I want to say 60 or 70% against gold in 31. US obviously did so in 33, 75%. Okay. So it took
20 years. It took World War II for us to come out. Well, we had the Roaring 20s. So
yeah, you had the Roaring 20s, and you had, there was, there were ups and downs, but even within that, it's the last thing you wanted to own was sovereign debt. Yeah, bonds just get, on a real basis, they got killed. And that's, I think we're starting that process again. It's not to say there won't be counter trades, but you can see why it happens. Is what's, for me, the bull case on bonds is that the Fed comes in and prints more money and caps the yield, starts buying them again. Well, you could make some money on bonds nominally if they do that. But there's way better expressions of that trade, right? Bitcoin's going to moon, gold's going to go up, stocks are going to go up, commodities are going to go up, much more than bonds will. So you're into this, I think the other side of, 40 years, bonds won no matter what, basically. And, we're sort of 9-10 months into bonds losing no matter what. And I think it's going to last longer than that, unfortunately, all else equal.
What a great time to have you, and thanks for cheering us up for the upcoming holidays, Luke. I mean, you're a straight shooter, and everyone can follow Luke at Luke Roman, and he's a very important part of my intelligence gathering, and consider subscribing to FFTT and check out Luke's writings and his YouTubes. You have a YouTube channel where you go over things as well every week, right, Luke?
Yeah, every other week or every third week. Yeah, we do a 10 or 12 minute update that we get a lot of good feedback on. So you can find that on YouTube.
Luke, thanks for being a watchman for all of us in these, I've heard an unprecedented amount of times in the last few months.
Yeah, so, there's some crazy things happening for sure.
Yeah, we need people like you to, keep an eyeball on what's happening so that we're not wrong-footed at the worst time. We appreciate your work. All right, Luke Roman, everybody. Thank you, buddy.
Thanks, Dale. Yep, thank you.
All right, so that's a wrap. My Trading Warrior brothers and sisters, and you could join the team in 18 minutes on the Morning Edge. Hope you enjoyed, Luke. See you guys tomorrow. And don't just count your pips, count your blessings. You guys have something to say? Yeah, Luke's great, isn't he? Yeah, okay. Well, everyone have a great trading day. We'll see you tomorrow for the big number. It's going to be a critical day. Ever heard that before? Every day is critical. Tomorrow will be critical too. Adios.